Welcome to Home Insurance 101. This session builds on what you learned in auto insurance. Now we shift to protecting the home itself. We'll cover what homeowners insurance is and why it matters, the 6 core coverages, common terms and rating factors specific to California, discounts you can offer, and myths we'll debunk together. A few sections today are marked for live whiteboard discussion. Your trainer will go deeper on those in person, especially around wildfire risk and advising on limits. For now, let's build your foundation. Homeowners insurance does 3 fundamental things: protects the structure, protects belongings, and protects against liability. Unlike auto insurance, homeowners insurance is not required by California law, but it is required by virtually every mortgage lender as a condition of the loan, and most lenders require dwelling coverage at least equal to the loan amount or replacement cost. Policies run on 12-month terms, unlike the 6-month terms on auto, so renewals happen once a year, which is an important touchpoint for review and cross-sell. Make sure clients understand that liability protection extends beyond the home itself. It can cover incidents involving their family, even away from the property, depending on the policy. These are the 6 coverages that make up a standard homeowner's policy. Most carriers will offer a default amount of each coverage, so you need to know all 6, what each one does and what percentage of dwelling it's typically based on. Coverage A, dwelling, is the foundation. It's what everything else is calculated from. Coverage B, other structures, covers things like a detached garage or fence. Coverage C, personal property, covers belongings. This is where scheduling high-value items becomes important. Coverage D, loss of use, is often overlooked but critical. If a client can't live in their home after a fire, this pays for the hotel or rental. Coverage E, personal liability, and coverage F, medical payments, protect against injuries to others. Liability limits should always be discussed in the context of the client's overall net worth. Get out your notebook because your trainer will go through real examples of each coverage in the live session. These are the core terms you will use in almost every client conversation about their home policy. A few to emphasize: named peril versus open peril is one of the most important distinctions to explain. Many clients assume their policy covers everything, when in fact it may only cover specifically listed perils. ACV versus RCV matters enormously for older homes or older roofs. Depreciation can significantly reduce a claim payout under ACV. Insurance to value is critical in California right now. With rebuild costs rising fast, a policy that was adequate 2 years ago may be significantly underinsured today. Roof age and type is a major underwriting factor here. Many carriers have specific age cutoffs or require roof inspections. Discounts strengthen your value proposition and help offset rising premiums, especially relevant right now in California. Multi-policy is the biggest one. Bundling home and auto or adding an umbrella can produce meaningful savings and also makes the client stickier. Protective devices matter more than people think. Ask specifically about monitored alarm systems, not just smoke detectors. Claims-free and new home discounts reward lower risk. Always ask how old the home is and whether there have been any claims in recent years. Gated community and professional group discounts vary by carrier. Always check at quote time since not every carrier offers every discount. These rating factors explain why 2 seemingly similar homes can have very different premiums. Replacement cost, not market value, drives the dwelling rating. A small home on expensive land may have a low market value but a normal rebuild cost, or vice versa. Construction type matters a lot. Frame construction generally costs more to insure for fire risk than masonry or concrete. Distance to the nearest fire station and fire hydrant is a real underwriting factor, especially in semi-rural areas. And the one that's most specific to California, wildfire and brush risk scoring, this has become one of the most significant factors in whether a carrier will even write a policy, not just how much it costs. We'll stop here and dive deeper on the whiteboard. We're covering 2 myths here that come up constantly in client conversations. Market value equals replacement cost. This is one of the most common misunderstandings. A client's $1.2 million home purchase price has very little to do with what it costs to rebuild it. We always use a replacement cost estimator, never the purchase price or Zillow estimate. Land value is included. Clients are often surprised that their dwelling limit shouldn't include the land. If anything, insuring a home for its full market value, including land, leads to overinsurance and wasted premium. The remaining myths will be covered in your live whiteboard session with your trainer. These 6 myths will be covered live with your trainer using real examples and carrier data. Brief context for each. Flood and earthquake. This is the single most important myth to correct in California. Standard homeowners policies exclude both. We'll cover NFIP, private flood, and CA earthquake authority options in the EQ and flood 101 session. Automatic claims-free discounts. Discounts depend on carrier rules, not a fixed schedule, and a single claim can reset the clock. Property only covered at home. Most policies extend a percentage of personal property coverage worldwide, useful for laptops, jewelry, and luggage while traveling. Home-based businesses. Standard policies have low limits for business property and equipment. Clients running a business from home often need an endorsement or separate policy. Paying off the mortgage. Coverage isn't tied to having a loan. The home and its contents are still exposed to loss regardless of whether there's a mortgage. Let's have a live discussion about these myths and other things you'll need to clarify and educate your clients on. This is one of the most important conversations you will have with homeowners. Why does carrying the correct amount of coverage matter so much? Because rebuild costs in California have risen sharply, especially after large wildfire events when demand for labor and materials spikes regionally. A dwelling limit set 5 years ago may be far short of today's actual rebuild cost. High-value items, jewelry, art, collectibles, high-end electronics are often underestimated by clients and underinsured under blanket personal property limits without a scheduled endorsement. Underinsuring the dwelling isn't just risky. Some carriers apply a coinsurance penalty, meaning even a partial loss may not be paid in full if the home was insured below a required percentage of replacement cost. And liability is real. A serious injury on the property can result in a lawsuit that exceeds low liability limits. These are the recommended limit benchmarks your trainer will walk through live with real examples. Dwelling. Always use a replacement cost estimator tool, never the purchase price or an online home value estimate. This is the single most common source of underinsurance. Other structures and personal property are typically a percentage of dwelling, but ask specific questions. Detached structures or high-value collections may need higher limits or scheduling. Loss of use is often forgotten. In high-cost rental markets, 20% may not be enough to cover months of temporary housing after a major loss. Personal liability should scale with the client's assets. For higher net worth clients, always bring up a personal umbrella policy. RCV over ACV and the water backup endorsement should be standard recommendations on nearly every quote. And the most important line, earthquake and flood are never included on a standard policy. This must be a separate conversation every time. Your trainer will run through real scenarios for each recommendation. This activity is designed to make sure you can read a real homeowner's D page and apply what you just learned. Hand out the sample declarations pages before starting. Give agents time to review independently. Then go through each question together. Question 1, dwelling limit. Agents should be able to locate coverage A and state the limit for each client. Question 2, scheduled versus blanket personal property. Agents should recognize whether a scheduled personal property endorsement is present or whether the client is relying solely on the blanket coverage C limit. Question 3, water backup / service line. A straightforward reading exercise, but flag for agents that this is one of the most common claim types and most commonly excluded by default. Question 4. This is the most important question. Compare the dwelling limit to a realistic current rebuild estimate. The recommendation should include updating the dwelling limit, reviewing personal property and loss of use accordingly, and discussing RCV endorsement if not already present. Debrief as a group. Encourage agents to explain their reasoning, not just give an answer. Great work getting through Home Insurance 101. You now have the foundation. What homeowners insurance does, the 6 coverages, how policies are rated in California, the discounts available, and the limits we recommend. The live whiteboard sessions with your trainer will fill in the detail on flood and earthquake exclusions, why correct limits matter, and limit recommendations with real client scenarios. After your deck page activity, bring any questions to your end-of-day manager check-in. Next up, EQ and Flood 101, where we cover the 2 perils every standard homeowner's policy leaves out.